Hello and welcome back to Brain Booster, your go-to channel for all things related to finance and economics. In this video, we're going to discuss a topic that is essential for anyone who invests in the stock market or any other asset: capital gain tax. What is capital gain tax? Capital gain tax is a tax that is levied on the profit made from the sale of an asset. This tax is applicable on any asset that has appreciated in value since it was acquired, and the gain is realized when the asset is sold. The tax rate varies depending on the jurisdiction, the holding period of the asset, and the individual's tax bracket. Types of capital gain tax. There are two types of capital gain tax: short-term and long-term. Short-term capital gain tax is applied to the profit made from the sale of an asset that was held for less than a year. Long-term capital gain tax is applied to the profit made from the sale of an asset that was held for more than a year. For example, if you bought a stock for $100 and sold it for $150 after 6 months, you would pay short-term capital gain tax on the $50 profit. If you held the stock for more than a year and sold it for $150, you would pay long-term capital gain tax on the $50 profit. Capital gain tax rate. The capital gain tax rate varies depending on the jurisdiction and the individual's tax bracket. In the United States, the capital gain tax rate ranges from 0% to 20%, depending on the individual's tax bracket and the holding period of the asset. For example, if you're in the 10% or 12% tax bracket, you pay 0% capital gain tax on long-term assets. If you're in the 22%, 24%, 32%, or 35% tax bracket, you pay 15% capital gain tax on long-term assets. If you're in the 37% tax bracket, you pay 20% capital gain tax on long-term assets. Short-term capital gain tax is taxed at the same rate as your ordinary income tax rate. For example, if you're in the 22% tax bracket, you would pay 22% capital gain tax on short-term assets. Deducting capital losses. One of the benefits of capital gain tax is that you can deduct capital losses from your capital gains. If you have a net capital loss, you can deduct up to $3,000 of that loss from your ordinary income tax. If your net capital loss is more than $3,000, you can carry over the remaining loss to future tax years. For example, let's say you had a net capital loss of $5,000 this year. You can deduct $3,000 of that loss from your ordinary income tax this year, and you can carry over the remaining $2,000 loss to next year's tax return. Capital gain tax example. Let's look at an example of capital gain tax. Suppose you bought 100 shares of XYZ stock for $50 per share, and you sold those shares for $80 per share after 2 years. The total sale price would be $8,000, $80 by 100 shares, and your total cost basis would be $5,000, $50 by 100 shares. Your capital gain would be $3,000, $8,000 to $5,000. If you're in the 22% tax bracket and you held the shares for more than a year, you would owe $450, $3,000 by 15% in long-term capital gain tax. If you held the shares for less than a year, you would owe $660, $3,000 by 22% in short-term capital gain tax. Now let's say you also sold 50 shares of ABC stock for $60 per share, which you had bought for $70 per share. In this case, you have a capital loss of $500, $70 by 50 shares, $60 by 50 shares. You can use this capital loss to offset the capital gain from the sale of XYZ stock. So, your net capital gain would be $2,500, $3,000 to $500, and you would owe $375, $2,500 by 15% in long-term capital gain tax if you held the shares for more than a year. Thank you for watching this video, and we'll see you next time on Brain Booster.